Welcome to this topic, amazing and wonderful, called startup finance. Too much in news, startups. Everybody is coming out with some or the other idea. They want to do great business, they want to create unicorns, but for that you need finance. Great idea will also require money for execution purpose. To execute a great idea, you would require investment in tangible asset, you will require investment in intangible asset, you will require a team who can execute your ideas. So that involves a lot of funding. Some startups are fortunate, they get funding, they are able to put their ideas into practice. Other startups have to struggle. In the beginning, when you have an idea only, generally nobody is going to finance you. People will not invest in only an idea. They want the actual execution of the idea, and they want to see whether this idea is actually being accepted by the market. You go to a bank and you say, I have this idea, give me money and then I will start working on my idea. Bank will say, sorry, okay, take this, you will not get anything, we are not here to lose our money, show me a business, show me revenue, show me a model which generates revenue, and yes, then come to us. So getting funding by startups is very difficult. Most of the funding at the very initial stage would be from your own personal resource, from friends, relatives, like that. But only when the business grows, reaches a certain stage, then yes, investors will also start coming in and providing funds to you. So that is the basics of startup financing. It means giving initial money, initial funding, providing initial funds to a startup company so that they can turn an idea into reality. There are a lot of youngsters, young entrepreneurs who have got wonderful ideas, but they don't have capital, they don't have money, and therefore there is an important role of startup financing which we are going to learn. If you also have some business idea and you want to execute it, this chapter will be useful to you. It will give you a broad idea as to what are the avenues available to raise funds for startups. As I told you that when you are a new company with an idea but which does not have actual execution on place, okay, you go to a normal business bank, you go to a normal bank, you go to normal NBFC and you tell them about your idea, they are not going to lend you money. Sorry, we are not interested, because you are a new company. Banks don't want to take such high risk by putting their money in a new venture which is not yet properly tested by the market. Lender, investors are really not very interested at a very early stage. So what are you supposed to do? Some of you are very passionate about your idea and you think, yes, my idea will definitely work. So how do you start a business when others are not financing? If you have assets, like if you may have some investment, you might have accumulated some savings in the form of shares, mutual fund, bonds, or you may have some other tangible asset, you may sell them to raise funds, or somebody can borrow against whom, or you can ask your loved ones, family and friends for the loans. So sometimes when you are a new company, these are the only options that you have: sell your asset, use your own resources, ask your friend, relative, they will come and they might help you. But taking funds from funds and relative is having some other negative possibilities also. What is that? You are not able to repay. Let us say your venture fails, your startup idea does not generate enough profit, but you have taken loan from friends, relatives. See how they will look at you. It will strain your relationship with friends and family if the startup idea fails and there is a loss. So how do I get success in the field of entrepreneurship? It's a big chapter. Entrepreneurship is not something which is a part of our syllabus, but yes, some ideas, some input can be given to you. For example, if you want to start a business, it is always better to speed up initial operations as quickly as possible. If it is only an idea, people will not invest. But once your idea becomes operational, they see it on the road, they see it on the ground that yes, this idea is working, then people will come to you. Okay, so if you have an idea, first to start implementing it as soon as possible, even at a very low level, but start, because the investor would ask the question, what is your revenue, what is your profit, who are your customers, and if you have nothing to explain to them, they are not interested. So then you have to reach a level, where the investor would start showing interest. They can see and feel that yes, there is a business, okay, and that person has taken risk to achieve that level. First great idea which our institute has given for the young entrepreneurship people or entrepreneurs is that start as early as possible. Make your idea operational as early as possible. Then probably you will be able to find some investor willing to put money into your idea. Otherwise, nobody will invest only in idea unless they see the execution on the ground. Some businesses can also be bootstrapped. What is bootstrap? Tick mark, exam question. For those interested in appearing for exam and getting marks, the question asked is what is bootstrapping? So bootstrapping means either you use your own personal finances, whatever you have saved, accumulated, you put that money in your business, or you use the operating revenue. Whatever revenue is generated by the business, you again reinvest it. You don't take any profit home, you don't take any dividend from your company. You are continuously recycling the same revenue which you are generating, plus you are putting your personal finances also. This is called bootstrapping. That is required at the initial stage to make your business reach a certain level. They can be built up quickly enough to make money without the help from any investor who might otherwise come in and start dictating the terms. Again, the institute is telling you better at the very early stage you try to create a business from your own fund, reach a certain level, then you ask investors to join. If you ask investors to join from the very early stage, there is a chance that they might start dictating terms to you, and instead of you putting your own idea into place, you are working for these investors, and they will keep on dictating terms to you to the point that they will harass you, to the point that you will feel like giving up that startup only, right? Because these investors will continuously push you to generate revenue, to make profit, to do this or to do that. So let your business first reach a certain stage. Okay, you should have a strong business plan. When you go to the investor, they will ask you, what is your business model? Which product or services you are going to offer which is needed by the market and you are able to cater to the market? how your business would be different from other businesses which are already into existence. What is your revenue model? What are the different ways you are going to generate revenue from the company? Who are going to be your employees? What will be your cost? What will be your margin? How are you going to scale up? All these answers must be ready before you go to the investor for raising the funds. It is always better to take the advice of experienced and experts who can guide you as to how to make business plan and how to approach the investors. Again, for exam purpose, innovative ways to finance a startup. Innovative ways to finance a startup, please tick mark. 4 mark, 5 marks theory question. You need funds, you are a startup. Normal banking channel will not provide you finance. Normal NBFCs may not provide you finance. Even if they provide finance, NBFC, they may charge a very high rate of interest. You can't afford that. They will ask you 36% interest rate per annum, 3% per month. You will think that whatever I will earn will be invested, will be paid in the form of interest repayment only. So therefore find ways to raise funds, and still you don't have a pressure to face the lender and investor. You need funds at the beginning. You have an idea, so you need to make a prototype of the product. You need to develop the product so that you can showcase it to the market that this is the product I have created. But to do that, you need fund. You will need funds for buying machine. You will need funds for inventory. You will need funds for paying salaries to your employee. How do you raise money for that? Okay, maybe you can go for bank loan, but usually banks are not interested in funding a startup company. You can go to non-banking finance company. They may also not be very keen, or they may charge a high rate of interest. So we have suggested the following innovative ideas, which may or may not sound innovative, but it's okay. One is personal finance. Use your saving to start a business. Now this is an advice to our students also. If you are planning to start your own practice or your own business, after you qualify, you will need funds. And suppose your parents or friends or family members will not support you with that, you will have to save your own, you have to use your own savings. So start saving from right now. Whatever you can save, save. Every day, whatever you can save, save. Every month, whatever you can save, save. So that by the time you qualify, you have some amount in your investment which you can use for starting a business. Why do you need to put your own money into business? If you go to any startup, or if you go to a investor, the investor has a question: how much capital you have invested? What is your contribution in the business? And you will say 0. I have not contributed anything, you only contribute everything. Do you think the investor will put his money on such a deal? They want how much the promoter is invested in his own business, how much risk he is taking with his capital, or what they call in their words, how much is your skin in the game. If you have no skin in the game, then you can do anything and still you can walk away. But when your capital is invested, you are serious about your business. You will take responsible steps to promote your business, and that is why own capital must be invested in the business. What is the next source? Personal credit lines. That means you can take the bank credit facilities or bank credit card. If you can take personal loan, very good, but normally interest rate is high, but at least you will get the fund. The other is credit card. You can use that credit card, pay later after 1 month. So for 1 month at least you have some credit available, you can use it for your business. But of course in credit card, if you default, the interest rate can be very high. Friends and family are always there with you. Family and friends are always there with you. They believe in you. They may not be fully convinced with you, with your ideas, but still they will support you. So you can go and borrow from friends, family, parents, if they can support you. But at the same time, one has to keep in mind that it might strain your relationship with friends or family members if you are not able to repay them. It is always better to have a promissory note or a written agreement so that later on there is no dispute. So that is family and friends. Next is peer-to-peer lending. That means a group of people, they usually provide funds to a businessman, okay, and it is found that usually they prefer to give funding to people in their caste or their the same ethnic group or something. So there is some common feature, and they try to help entrepreneurs in starting a business. That is peer-to-peer lending, where people come together and they lend each other money. This is found in small and ethnic business group. I will not take name of any ethnic group, caste group, racial group, but it is found that they will promote their community by giving funds so that their community people can start business and they can grow. They have similar faith or interest, generally support each other in their startup activities. And what is next? Crowdfunding. Write down important for theory question, only one simple 4-mark question. What is crowdfunding? So because of the internet, social media, okay, like Facebook, Twitter, Instagram, and I don't know, there are many more. I don't get time to watch all these activities on Instagram, Facebook, but some basic idea. Now you will make a post there, put a post that I am starting a business, I have this idea, I need funds, I request all the like-minded people to support me in this venture. Plus there are crowdfunding platforms also. They may charge some fees and then they will spread the message to a large number of people, and then many people who may believe in your idea, who may want to help you, they will come forward and they will give you funding. So small amount, but from a large number of people can become a big amount, and therefore you can start your venture. So this is a good idea to raise funds by a startup companies, and sometimes it works also. They are able to raise lakhs and crores of rupees if they present their ideas well, and if it is accepted by the people using social media and such sites. Okay, that is crowdfunding. And the next is microloan. These are the small loans given by individuals at a lower rate of interest to new business ventures. So this is microloan, means small amount of loan. You want to start some business, maybe you need 50,000, 1 lakh, 5 lakh. You will approach individuals who provide funds to you at a lower rate. These loans can be issued by one single individual, or it can be issued by a group of individuals, each contributing a small proportion of the total amount. Next is vendor financing. Sir, what is vendor financing? This is very easy. It is purchasing on credit. You ask your supplier that I will not be able to pay you now, but I will pay you after a month. but deliver me inventory, deliver me machine. You have to explain your idea to the vendor, because even vendor will not be very keen on selling on credit if there is a risk involved. But it is a very good medium of raising funds by a startup company. By tying up with the vendor, vendor may also feel motivated that his products are getting sold. Startup companies benefited, they don't have to pay immediately. So therefore some benefit is there where you have to approach the vendor and ask for credit. So that is simply trade payable. You can write there trade payable. You may pay after 30 days, 45 days, 60 days, 90 days as per the agreement, and for that period you are able to use the money, and which is very important for a startup company because you need funds for your working capital. Next is called purchase order financing. What is purchase order financing? You have received a purchase order. You have received a purchase order. I hope you know purchase order. You get an order from the customer. He wants to purchase so many units of this product. But then in order to manufacture those units, you need money. Sometimes you get a large order. Customer wants 10,000 units to be delivered. Getting a large order sometimes is not a very happy news because you don't have resource to fund it. Then you go to certain companies or banks who will give you loan on the basis of the purchase order, because now the lender is sure that this person has got a purchase order. He has got an order to execute 10,000 unit, but he needs money so that he can purchase raw material or input or whatever required. So he will make a payment directly to the supplier. Whatever raw material input you require, the amount for that is directly paid to the supplier. The financer will make directly payment to the supplier of the goods, to whom you have to make payment. Okay, so A has to pay to B for the goods purchased. Financer will directly make payment to supplier, and then supplier will deliver goods to A. A will then process the goods, execute the order. A will process the goods, execute the order, and later on the customer will make the payment. Customer remits the payment, and then the financer will keep the commission or interest and remit the balance amount to you. That is how purchase order financing will work. If you want, you can draw the diagram. You can draw the diagram in the notebook. Our institute will not give you diagram. Let the student visualize. So first is my starting point is here. You will move in this order. Your customer sends you a purchase order. Your customer sends you a purchase order, and then what the financer does, V stands for financer. This diagram I have taken from a finance company which is providing purchase order financing. Here V means the financer posts a letter of credit to your supplier. So the financer will make payment to supplier. Point number 2. Financer will make payment to the supplier. Point 3. Your supplier delivers the goods. Your means the customers, the startup company. The startup company supplier delivers the good. Then point 4. Your customer accepts the order. Now your customer, you manufacture the goods, process the goods, your customer accepts the order. You invoice your customer for the order. You means the startup company. You means startup company. We means the financer. Here you means startup company, we means financer. Your customer remits payment to us. And the last step is we collect our fees. And remit your profit back to you. This is how purchase order financing can be done. Good for a startup company which receives a large new order, but then it finds that it doesn't have the funds to execute that order. Therefore, purchase order finance companies often advance the required funds directly to the supplier. This allows the transaction to complete and the profit to flow to the new business. Is it right? Have you noted it? Have you noted this? Yes or no? Is the diagram over? Very good. So this is purchase order financing. And the next is factoring accounts receivable. Have you heard about factoring? In factoring, what happens? I'll briefly explain. Suppose this is the startup company. It sells goods to a customer. But then customer will pay after 6 months. So startup company goes to a factoring service company and it gives invoice to the factoring company. The factoring company will pay about 80 to 90% advance of invoice value. Then the factoring company will collect from the customer the amount on due date. After collecting the amount, it will pay the balance amount to the startup. After collection. So this is, you can say, follow up with the customer, collection from the customer, and then paying the balance amount to the startup after deducting interest and commission. This is called factoring arrangement. The factor takes the responsibility of follow up with the customer, monitoring the customer, collection from the customer, and providing advance to the company. Company's cash flow is not blocked. The startup companies knows that once it is able to make a sale, then it can approach a factor who will purchase the invoice and it will be able to get the advance against the invoice immediately. That is called factoring. So factoring is a facility is given to the seller. Here seller is the startup company who has sold the goods on credit to fund is receivable till the amount is fully received. When the goods are sold on credit, the credit period can be 6 months. Factor will pay most of the sold amount upfront and rest of the amount later. So today he may give you 90% and afterwards he can pay you remaining amount after deducting interest and commission. Therefore, startup company can meet his day-to-day expenses. This is how factoring arrangement works. Startup company sells goods to the customer, sends invoice to the factor, factor give advance, factor does follow up with the customer, collects the amount and pays the balance amount to the startup company. Startup company can meet his day-to-day expenses. Now next part is pitch presentation. Very important. Very important, not only for exam but also for your future life. In case if you have to raise funds from the startup, for the startup from investors like venture capitalists, you have to go to them and you have to explain your entire business, product, everything in a very short span, such that they feel interested in your product, they feel interested in your business, and they may feel like investing in your business. So you get a chance to present your idea before investors. They will give you some time, let's say 20 minutes, 30 minutes, an hour, and in that short span you have to convince the investor about your idea, about your product, about your business, and then you will be able to get the deal done, you will get the funding. So what you have to explain in that, you have to explain the prospects of the company, that what is the vision of this company, what product they are manufacturing, how it is going to be a game changer, or how it is going to generate revenue, how it can be scaled up. You have to explain why they should invest in your business. If somebody is putting money into your business, he must be convinced that this business is going to earn profit for them. Therefore, you can take the help of tools like PowerPoint, which we are doing right now, and you can give a quick review of your business plan as to how your business will operate, and then you have to convince the investor to put their money. So presentation is very important. The first few minutes you have to attract the attention of the investor so that they will feel to listen to you for more information. How is pitch to pitch presentation made? You can meet face to face. In case if it is possible, you can go to the investor's office and you can explain your idea. Sometimes they will prefer to meet virtually or online meeting. That will save time, efforts of traveling. But nowadays it doesn't matter, because the online softwares are so good, you don't feel like you are not in a face to face meeting. Then you have to meet online or face to face with potential investor, customers, partners, co-founders. So all these people can come together face to face or online. Methods highlighted below as to how to approach a pitch presentation. Now next paragraph is really very important for anybody who has got an idea and who wants to make a pitch presentation. For example, your introduction must be given very briefly about who are you, what is your qualification, what is your experience, what are you doing, and it has to be kept very short and sweet so that the investor don't go into the sleep mode, and you have to present it in a very nice, attractive, convincing manner. Let the investor get interested in your company. You have to say something that it will create interest. You have to give interesting facts about your business. For example, let us say Ola company founder goes to the investors. Then he will say, India is a big country. Do you know how many people travel every day? Crores of people. And what do? They have to wait for bus, they have to wait for auto, they have to wait for taxis for hours. And suppose they have to travel at night, there is no transport available. So here I have an idea, Ola, the customer can just go to the app and order any time. He can make a choice of different apps. It will really make life very easy for a daily traveler. Wow! If you give such kind of presentation, then you will be able to attract the attention of the investor. Then after that, in case if your business is already there, you have to tell them about the milestones you have achieved, like how much profit you made in the last 1 year, 2 years, 3 years, how much revenue you have earned, also give them information about the team members, the core team members, the main people at management level, that who are the people running the show. Inform them who are your CFO, CEO, MD or technology officer, marketing officer, because if your team is strong, qualified, experienced, full of enthusiasm, then the investor would be interested in your product or service. If you may have an idea, but if you don't have a team, then probably it won't attract the attention of the investor. You have to highlight that your team is experienced, we have been working for so many years. Next thing is you have to answer what is the problem you are going to solve. A startup company has an idea, a problem they want to solve for the masses, so that the idea can be converted into a commercial proposition. So what idea you are going to solve? So Ola company solve the problem of traveling for a large number of people. Book My Show, easy to get a booking for any show, movie, concert on your app. Earlier we used to go to the theater to purchase a ticket in advance. So it was like two-way, or 2 times I have to go to the theater. 3 days before, 4 days before, I used to go to a theater to do advance booking. Now I don't have to do that, and I am willing to pay a convenience charge for that. Is it right? So that way this Book My Show has solved my efforts of booking a ticket. Or there are websites where you can do booking of airline ticket, railway ticket. So what they are doing? They are solving the problems. What is this online education software doing? Right now you are learning on an education software only. This is solving your problem. The student may be sitting in Karnataka, Tamil Nadu, Delhi, Mumbai, and they are all able to connect to me. So that is the problem we are trying to solve. And if your product or service is going to solve a problem, then this will really attract the attention of the investor. There are a lot of problems. As a startup company, look around you, you will find there are so many problems that we need to solve. Okay. So one example is given of Facebook in your book. In your book, there is Facebook. Before Facebook, some of you may be aware, some of you probably, because it is very old, it was around 2004, 5, 6, when Orkut was very popular, social media. But then Mark Zuckerberg came out with Facebook. Orkut was not very private. All your information was available for everybody to see. Anybody can go and watch your profile. Facebook started giving some privacy. You can do the setting of who can see your profile, to whom you can make your friends, etc., etc. Because of that, people want privacy, even if they are on social media site, but they don't want anybody to just enter into their profile and get all the information. Only their friends whom you have accepted should get. That idea was revolutionary. And then almost everybody has shifted from Orkut to Facebook because of the privacy setting which they provided. A small change, but it made this company very popular. Next thing, in your pitch presentation, you have to offer the solution. What is the problem you have to highlight, and how are you going to provide a solution to the problem? Like another case study is given for Flipkart. Flipkart, yes, it has created a revolution in online shopping. Before Amazon, Flipkart was there, and it was hard to believe that you can order anything on the app and in the next 1 or 2 days the order will get delivered. But Indian mentality at that time was not to pay online. Because of online fraud, you don't trust a company. Flipkart was new in 2007 and the idea was completely new, that is making online purchase. So what they did, they started COD, cash on delivery. Let the customer first see the product, feel the product, get convinced that yes, I have received my product, and then let him pay. So that idea of COD was added, so that made it popular. Then as the order started increasing, you have to ensure that you are able to execute the order on time, and therefore they started their own supply chain management system also. So they have a full supply chain management system whereby the orders can be executed very fast, because if the customer orders on 1st of the month and if he receives on 20th of the month, then it is of no use. So you have to execute the order very fast on an online platform, and for that they made lot of changes in their business model. They brought supply chain management, and as you know, they got funding of more than $17 billion from Walmart. In today's world, product may be very good, but it requires marketing and sales effort also. It requires a big market where your product can be sold and you can generate income from that. Because what is the use of a great product if there is no market for that product, if there is no customer for that product, and investors are putting their money not just to ensure that a dynamic or a great product comes into the market, they want a return also on their investment. Tell the investor about market size of the product. What is the overall market size? Who are your customers? What is your customer base? And if the product is already selling in the market, then you have to also give information about the growth rate in the sale, the forecasted revenue, etc. That will be useful information for investor. Next is, you must inform investor about projections or milestones. That is, how much sales or how much profit you are going to achieve over a period of time. How much market share you expect to achieve over a period of time. Because you are a startup company, you may not have a past history, but at least you can make a projection about future profit or sales or market share, and if required you can make projected financial statement like balance sheet, P&L account, and who can do it better than a CA. So what are the projected statement you can present? The projected statement you can present is your income statement, that is your profit and loss, where you are going to disclose how much revenue you are going to earn, what is the cost of goods you are going to incur. You can give monthly profit statement, you can give quarterly profit statement, you can give annual profit statement. Usually for the first year, monthly projected profit and loss is given. For second year or third year, quarterly profit statement is provided, and then thereafter, once you think the business will stabilize, you can provide for annual statement. You have to also provide cash flow statement. More than profit, now investors are looking for cash flows. How much cash flow will this project generate? Many companies may have profit but they have negative cash flow. The investor wants to know, when would the company become cash positive? How many years will it take to become cash positive? And this will affect the decision of the investor. So prepare a projected cash flow statement. Prepare projected balance sheet which will show what will be your assets, liabilities, net worth over a period of time. So these are the projections or milestone. Next is competition, very important. In your pitch presentation, you have to inform the potential investor that you are operating in an industry and these are the other competitors who are selling similar type of products. But how is your product different from the competition? If any of the competitors you have acquired, then you have to give details about the competitor whom you have acquired, like their name organization, price paid, etc. When you will go to the investors, they are surely going to ask you a question. What is your business model? Now, what is the meaning of business model? Business model means how your business will generate revenue. What will be different revenue streams? What will be your cost structure? What infrastructure strategies you are going to use? All this combined together is called a business model. So business model is a very wide term, and business model includes various aspects, especially the purpose, the process, customer, offering, strategy, infra, organizational structure, sourcing, trading practice, operational processes and policies. So the target investor would be interested in knowing how you are going to generate revenue from that. There is one example printed in the book about two companies selling the same product but have different business models. I will briefly explain what is the story. Two companies are doing renting of movies. Renting of movies. You can read the story later. One person has got physical stores, because that is what used to happen earlier when there was no internet. We used to go to the video parlors and we used to take on rent those CDs or DVDs or video cassettes, but now it is online. Once the customer makes the payment, he can download the movie and he can watch it. The other company is now renting the movie on internet. So this business model, physical store, this business model, online. So how does this company, which is now pitching for raising funds, is different from physical store? Revenues 5 lakh for both of them. Revenue, for example, let us say 5 lakh, but if you are running a physical store, your cost of operations, operating cost will be 4 lakh, because there is a rent, more employees needed, more electricity, power and other infrastructure costs will be required. So profit is 1 lakh. Whereas the company which is doing business online, it has 2 lakh rupees of operating cost. So the profit may be 3 lakh. So that is how the company which is now raising funds for starting an online movie renting business will explain its business model, that we are going to provide movies on rental online where the customer can download, and how it is going to be beneficial. Our operating cost will be lower and we will be able to generate much higher profit than what a physical store will make. Business require finance. Startup company require more finance. The investor wants to know how have you funded till now and how much more funds do you need. Then if you have already raised money, they ask this question, have you raised money? How many rounds of funding you had? Who are your investor? Then you have to tell your investor that this is the amount of money we have raised. Who are your investor? When did you raise money? And if you have not raised the money till date, then you have to explain how much work has been accomplished with the help of minimum funding that the company is managed to raise. Because if you have no business, probably your investor will not be interested. So you have to tell them that we have completed so much of work and now our business is ready to operate. How much money you have invested, you have to tell them also. Always the investor would be interested in knowing how much the businessman has invested his own money. And if you are going to raise funds, then you have to explain how much funds you are going to raise. Why do you need funds? And how are you going to use that money? These are some of the details you have to include in the pitch presentation. You will see there are TV programs like Shark Tank where exactly what was written in this pitch presentation is there. So if you are interested, you can watch that program Shark Tank, which probably you can find on internet also. It is a program, and then even internationally there are similar programs in other countries where these startup companies go and make presentation to the investor, and what we discussed was also mentioned in that Shark Tank also. So today we'll stop here, we'll continue tomorrow. Thank you very much. See you tomorrow. Let us continue with this startup finance. Previous lecture we have seen up to pitch presentation. Now the next part is modes of financing for startup. Because tomorrow you are also going to become a startup company, probably, who knows, you may also have some idea, and you will require funds. Where will you approach? So this chapter is a very good compilation of everything about startups. How the startup should make presentation, how should they raise finance, different alternatives you have. In the later part of the chapter, we are going to also see the startup initiative taken by the government. One question which they ask in the exam, a general question, methods of financing for startup, or they can only ask you question, what is bootstrapping in case of startup. So bootstrapping means when the startup company is trying to form and build an enterprise from personal finance. Right now it is a very new company, it doesn't have revenue or it may not have profit at the initial stage. Banks, lenders are not very keen, so you'll have to depend on the personal finance, or whatever income you are generating from your business, the same revenue will be reinvested to run your business. That is called bootstrapping, personal finance plus use of operating revenue for running the business. What important care one has to take in the initial stage of the business? They have written, when you are a young budding entrepreneur, you want to grow very fast, and then you start incurring lot of expenses. Like for example, you incur huge marketing expense, but there is no corresponding revenue. Some of them will hire a lavish office equipment which they can't really afford. At this stage, at the early stage, when you are using your own finances, such wasteful expenditure should be reduced or avoided. Because if you incur more expenses on this lavish item like a big office, all posh equipments, all heavy expenditure on marketing, then you will have less money available for business purpose. More money at the inception of a business. If you have more money, suppose your personal finances are very high, then it will lead to complacency and wasteful expenditure also. So investment in startup from their savings should be done. This will make you cautious. When your own money is involved, when your own skin in the game is involved, you are more cautious about spending the money. Some more ways in which the the startup can finance are trade credit. Already explained to you, trade credit means paying to the supplier at a later stage. Maybe you can get a credit of 1 month, 2 months, 3 months, 6 months. When you are a new business, even the creditors are not very keen to give you credit. Creditor will also insist on cash payment or making payment by credit card. Very difficult at the early stage to convince a creditor to give you credit for 1 month or 2 months. So the only good thing you can do, what is in your hand, to make a well crafted financial plan, make a good business plan or financial plan, go to the creditor, sit with him, talk to the owner, talk to the management or the CFO and convince him about your business plan. You have to tell him that if our business becomes successful, which we think we can succeed, you will get all the orders from our company and you will also participate in our growth also. If you can convince the supplier, CFO of the supplier, owner of this supplying company, then in that case probably they may like your business plan and they may allow credit period. A good communication skill is very important here, because you have to effectively communicate about your business and the business potential. Next is, as I have told you earlier also, factoring arrangement. That means you will get your invoices discounted by a factor. This diagram I have drawn earlier also. I will not read line by line, but I will explain with the help of a diagram. So you have, suppose, a customer, right? Goods sold to customer. You can in the exam draw a diagram also. Goods sold to customer, step number 1, and then there is a factor who provides factoring services relating to receivable. Enter into an agreement with the factor, because finances are involved. Then agreement is signed between the company and the factor. Once the goods are sold, then you will share invoice to the factor, share invoice with the factor. Point number 3, you will share invoice with the factor. Then what factor will do? Factor will give you advance. Factor will give you advance against invoice, and that is what you want. The amount of advance can be anything from 80 to 90% of the invoice amount. Entire 100% advance may not be available because the factor wants to keep some margin. There can be bad dates, there can be sales return, and the factor wants to also earn some interest and commission out of it. Then what this factor does? The factor does the follow up. So this I will write it as follow up with the customer. So you don't have to do follow up work with customer also. You don't have to follow up with the customer. That saves the time and energy of the startup company. Then the factor collects the amount, collects amount from the customer. It is the customer is informed to make payment to the factor. And then the last step 7, remits balance amount to the startup company. Balance amount means total amount collected minus advance given minus interest minus commission. So that balance amount is remitted to the startup company. So how is startup company benefited here? The startup company does not have to wait for 6 months to recover money from the customer. Suppose the invoice amount is 100, 80-90 rupees he gets immediately after the sales are made by selling that invoice to the factor. And that way the money keeps rotating. The money cycle, the cash cycle is moving, and it helps the startup companies. That is how factoring is used. factoring are very important for startup companies, because otherwise they will not get loan from banks or other financial institutions easily. So the only way to keep your cash rotating is to get advance against your invoices. It also helps indirectly, you don't have to follow up with the customer. So all those follow up costs, administration costs associated with receivable management, bookkeeping, account keeping are also reduced. And now the next is leasing. Very important source of finance for the startup companies. Why it is a very important source of finance? Please understand, you are a startup company and you require, let's say, office space, you require machines, equipment, computers, furniture. If you buy all these assets, office, furniture, equipment, computer, machines, then it is going to cost you a lot, and you don't have that much capital. So what is the other alternative to acquire these assets? You can take it on lease. So you go to a company which is called leasing company or lessor. Let us call it lessor. Okay, and the lessor company will provide you the asset, whatever asset you require is provided to you on lease, and then you make lease payment. Your entire capital is not blocked, only some part you have to pay every year. And then these lease payments can be very flexible also. You can negotiate with the lessor the timing and the amount of lease payment according to your paying capacity. Okay, so that way your capital is not blocked. You don't require a heavy capital to start up your business. Most of these startup companies follow this route only. The entire office that you see for a startup company, they don't own anything. Even the computers, laptops, mobile phones, furniture, everything is on rent or lease, because they don't have capital to invest in all such asset. And also, if you purchase all these assets and suppose the business does not work, then you have to sell them, and when you are going to sell them, it is going to cost you a lot. So the benefits to the startup is no investment in capital goods, so that investment is saved. Lease rental is tax deductible. In case if you make profit, which you will not, but suppose you make profit, it is tax deductible. Cash flow can be planned. And it gives you flexibility. If you don't like some asset, you can return it. So it gives you flexibility. If you want a bigger office, you can move out from the old one and move to a new office. At the initial stage, we don't know what will be my office space required, what will be my equipments required. Maybe you can go for leasing arrangement, and you can be more flexible with respect to assets that you would require. So this is a leasing advantage for the startup companies. Next is another important concept in case of startup business is angel investors. Who are angels? So these are investors who help us startup companies, who provide funds to the startup companies. If they see there is a potential in a startup company, they will take personal risk and they will give funds to the startup company so that the startup company can start business. Many persons or individuals and in their personal capacity they provide funds to startup companies, and that is why they are called angels. So like angel, they are going to help a newcomer, a startup company to set up a business. They usually are individuals, high net worth individual, they can be a group of individual or even a entity also. They take equity stake in the company so that if the venture becomes successful, they will also earn a high rate of return. They guide the entrepreneur also, the startup companies, because these angel investors comes with lot of experience. They have already achieved success. They have already helped many other enterprises. So they also share their experiences with the startup companies, and the startup companies get the benefit of their knowledge, their experience. Hence they are called angel investors. So angel investors are people or investors who helps small startup companies. Okay, this angel investor can be families, family members and friends also. Your friend can also be an angel investor. If he knows you, he knows about your potential, he can fund you. The capital angel investor provide maybe a one-time investment. So what are the points you have to add in your answer? Sometimes they may just provide one-time amount, or they can give more than one amount also, so that the business will keep on moving, because initial capital may not be enough and therefore more funding may be required as we go ahead. So they can provide funds also at a later stage. Continuous supply of funds is also possible. I have found on the website some of the India's top angel investors like Mohan Das Pai, Ratan Tata, Kunal Bahal, Rohit Bansal, Rajan Anandam, Anupam Mittal, then Chris Gopal Krishnan, Sachin Bansal, Binny Bansal, Jishan Hayat, Vijay Shekhar Sharma, and below that I have written, which you can check later, the name of these startup companies where they have provided funds, and some of them became very successful also. Like this company Car Dekho is a $1 million company now. Is it right? Angel investor provide more favorable terms compared to the other lenders. That is, they are not like very greedy investor. Yes, they need funds, they need return, but their terms are much favorable than other very greedy and very difficult investors. They usually invest in entrepreneurs starting the business rather than the viability of the business. So that is why they are called angel. They help in starting the business. Nobody will help you when you are starting a business. People will come to your help when you have become successful. Bank will lend you when you have a business already in place, generating revenue and profit. They don't come at the early stage, startup stage. Angels come at this stage, and that is why they are called angels. They help the startup companies to take their first step. Sometimes the startup may not have any capital, but a good business idea, so they will provide funds rather than possible profit they may get from the business. They may search for return, but they are not desperate after the profit. Essentially, angel investors are opposite of venture capitalists. Why? Because venture capitalists are sharks. They will suck your blood. They will continuously interfere in your working. They will ensure that you meet the milestones. You report to them. In case if you are not able to achieve targets, They will ask for explanation. They can even change the management of the company. Oh my God. So taking money from venture capitalist means you have to listen to their terms and condition, and continuous interference you have to tolerate. Same is not in the case of angel investors. So these angel investors are known by other names also: informal investor, angel funders, private investor, seed investor, or business angels. You can call by any name. Who are these people? These are usually affluent individuals whom we call high net worth individual or ultra high net worth individuals. They have already achieved a lot. They have got huge capital. Is it right? Like Ratan Tata and Sachin Bansal we have seen, Binni Bansal, Anupam Mittal. They have already earned a lot, and therefore now they want that they should help other businesses also. So they inject capital for startup in exchange for ownership equity or convertible debt. Either they will get equity or they may go for convertible debt, so that it will be converted into equity share at a later date. Some angel investor invest through crowdfunding platform also. In the earlier discussion we have seen crowdfunding platform where many investors, they come together, they contribute money so that new businesses can be set up, or they build angel investor networks also. So in case if you are planning to raise funds for your startup, find out such crowdfunding platform, find out such angel investor network, approach them, give them about your business plan, your business idea, and probably you will be able to raise funds. Okay. They use their own money. Usually they are rich people. They use own money. They are not like venture capitalists. Usually in venture capital, it is a pooled money of many investors. Rather in angel funding, they use their own money. Next is, though angel investor usually represent individual. Usually they are individuals. I had shown you some pictures of some leading angel investors, but the entity may provide funds through a limited liability company also. So they may form a limited liability company like private company. Some of them have got a trust, some of them have got investment funds. So each according to his own convenience and requirement, either it can be in personal capacity or through a company or through a fund or a trust. Nowadays they call it family house or something. Okay, family office. Nowadays a new fancy name is given for such investor called family office. One of my student recently came and met me, and he says he is working in the family office of some ultra rich businessman, and they are managing the funds. They are also providing funds to startup companies. So that is about angel investor. Last paragraph, angel investor who seed startup that failed during the early stage lose their investment completely. Keep in mind, there can be losses because you are funding a startup, you are funding a new business, you are funding a business which has not tested success, which is putting an idea into practice which may or may not survive. Therefore, there can be losses also. Angel investors know about it, that there can be losses. Out of 10 businesses they will finance, 5 or 6 of them will shut down or will fail, but 3, 4 or 5 of them can be successful also. So professional angel investor look for opportunities for a defined exit strategy. What is the meaning of that? They will give the funds, but at the same time they will check what is my exit strategy. Exit strategy means how can I sell my investment and get the cash back? That is exit strategy. You invest your money, but at the same time you want that I should be able to redeem my investment. So how do I redeem? One option is this startup company can be asked to go public, that is IPO, and once the company gets listed, you can sell your stock in the stock market, or in the IPO only you can offer for sell your stake, that is your stake can be sold to public in an IPO. Sometime, which is not written here, they may sell their stake to the promoter. They may sell stake to promoter. They will enter into an agreement with the promoter that after 5 years, the promoter will purchase their stake at a certain premium. That can also be an exit policy. So that is called angel investor. Now we'll come to venture capital fund. These new startup companies usually get funding from venture capitalists. That is those funds, those entities which take huge risk in investing in new businesses. That is why they are called venture capital. Venture means risky, high risk is involved. Statistics shows that out of 100 entities or enterprises which are funded by VCF, out of 100 enterprises which are funded by VCF, 90% of them fail. 90 or more than 90 also sometimes fail. So how many of them are successful? 10%. Out of 10 also, maybe 2 to 3% are highly successful. Then your question could be, then why do these venture capital funds invest in businesses where the success is only 10%? I will ask you why you are doing CA course. Why are you doing CA course where the success rate is 10 to 20%? Same answer. People love to take risk. People love to take risk. You are also a risk taker. If you are watching this video till this point, you are one of the risk takers because you know the success ratio. But if you pass, it is a huge success. Then your entire future life, you can earn a good amount of salary, you can earn a good amount of income, you have a respect in the society, whatever your views are, people will respect it, growth is very high. Some of our students who passed, let's say 10 years ago, and they still come and meet me, their salaries are in crores now, 1 crore, 80 lakhs somebody, 60 lakhs, huge amount. These are insane amount. After 5 to 10 years, if you start earning this kind of money, it's insane. Even your parents who have completed 30 years of service will not be earning the same amount of money which you will start earning in the first 5 years only. Okay, that is CA, and that is venture capital fund. If some of them become successful, they will recover whatever amount they have lost in the other ventures. Some of the greatest success stories are in venture capital field: Facebook, Google. Okay, these are some great success stories, and now they are billion-dollar companies. Or Twitter, they are billion-dollar companies. And those who had made investment in the early stage, when nobody knew about this company, they must have earned 100 to 200 times of their investment amount in a small period of time. That is the power of venture capital investment. So let us come to the discussion of what is venture capital funds. These are funds which are usually in the form of company or trust, and they provide funds to startup firms and small businesses. Startup firms and small businesses, right now they are small when they are funding them, but have a huge growth potential. Once the business becomes successful, they will recover many times of the amount they have invested. This venture capital are run by professionals. They are highly qualified, highly experienced, highly talented professionals who can manage the funds of those who have got huge net worth. Okay, and they invest in young companies, rapidly growing companies, and that have potential to develop into significant economic contributors. So the startup companies will go and present their idea. The startup company has to demonstrate that your idea, if successful, can become a game changer and can generate huge return for the investors. Okay, so some companies like Zomato, they have become huge money earner for their initial investors. It got listed, and those who invested earlier must have made 10, 20, 30 times return by now. So what do venture capitalists do? The venture capitalists are these investors who finance new company and rapidly growing companies. They look for such companies where the growth potential is very high. They buy the equity shares of such companies because the value will grow exponentially only if you have equity investment, because the value of equity can increase multifold. They assist in the development of the new product or service also. Venture capitalists are experienced people. They have got lot of experience of financing similar businesses, so they may help you. They will help the startups in developing new products and services, and they also provide advice. Okay, and their advice is very valuable because of their experience, knowledge, awareness. They give lot of valuable input in the form of advice and guidance to the startup companies, and that is how startup companies benefit from the venture capitalist. Question in the exam: what are the characteristics of venture capital financing? You can also join a team of venture capitalists, and then you will have to fund a large number of startup companies, or you can be a startup company and then you should know how to approach venture capitalists and how to raise funds from them. Both way possible. Some of my students are working in venture capital firms, so they fund the startup companies. Some of my friends are starting their own business in some new field. They need money from venture capitalists. Okay. First point about the venture capital financing is they have a long term horizon. They don't invest for 1 year, 2 years. Minimum they invest for 3 years. Although there is no maximum limit, but usually they want to exit within 10 years by making a huge return. So that is long term investment. Second is when usually they invest in new companies. These new companies are private companies, unlisted companies, so their money gets blocked. because you can't liquidate, you can't sell it to others. Of course, you have to find somebody who is willing to purchase your stake, but otherwise your money gets locked up. Venture capitalist knows that he is investing in a venture where money will get blocked, there will be less liquidity, but that is taken into consideration while negotiating the price today and while negotiating the exit price at a later stage. So they will consider the fact that our money got blocked for 3 years, 5 years, and that is considered at the time of negotiation, at the time of initial investment and at the time of exit also. Venture capitalists know that his investment is subject to very high risk. What is the meaning of very high risk? You lose everything. But then why do they take risk? That is their nature. That is their peculiar feature. They do not hesitate to take high risk. Because if the risk is more, then the potential returns are also high. Out of 900 firms they will finance, even if 10 of them become successful, even if 5 of them become highly successful, their return will be more than what they have lost in the other 90 firms, and that calculation is in their mind. So high risk would not eliminate the investment choice for a venture capital. They know the risk. Otherwise, you enjoy your normal return, 8%, 10% return. If you don't want to take the risk, invest in government bond, invest in debt bonds, right? But no, they are not happy with that. They want multi-bagger return, 10 times, 20 times, 100 times return of their initial investment, and they take that risk. Usually, they will participate in the form of equity financing, so that when the company gets listed, and it gets listed at a heavy premium, once it gets listed, they can offload their stake at a very high price and will earn a very high rate of return. Because they are equity participant, they sometimes get a board of director seat also. Their representatives sit on the board. They guide the company, they help the company in decision making, they share their experience, and that way they help a startup companies to grow. Beside, a lot of board decisions can be supervised by the VC if they participate in the equity of the company. So by participating in equity, basically you are able to participate in the decision making process of the company also. One more thing I will discuss: advantage of bringing venture capitalist in the company. Why do we need to bring venture capitalist in our business? Is it good? Is it bad? That also one has to see. There is no harm in bringing venture capitalists, but you have to understand what can be the implications. One is, the funds provided by this venture capitalist are for long term. So you don't have the repayment obligation immediately or in the next few years. And this capital provides a base for solid future growth. Venture capitalist is a equity owner, so he is going to share the reward, but at the same time he is going to share the risk also. If the business becomes successful, venture capital enjoys the success, but if the business fails, then he might lose. Another reason for bringing venture capitalist is that they are very experienced people. They have got lot of business knowledge. They are dealing with so many firms, industries. So they bring their practical knowledge and experience and share that with the startup companies, and which will benefit the startup companies. Another benefit is that these venture capitalists have a network. In business, networking is very important. They can connect you to different people who will help you. So the network of the venture capitalist can be used by the startup company, and that will add value to the company. Next is the venture capitalist can provide you another round of funding also, which we will see in the next paragraph. There is a first round, second round, third round, fourth round. So as the business will start taking shape, start growing, they need more money. Venture capitalist can bring a second round of funding, can bring a third round of funding, so that the company's growth continues. Venture capitalist will also help you to perform all the formalities to make your company a listed company. So they'll prepare you for IPO, and your company will be listed on stock exchange, like in India BSE, NSE, in USA it is listed on NASDAQ, New York Stock Exchange, and then it also provides people to participate in that company's share when you start trading. As a promoter, you can also have an exit route, and venture capitalists usually exit after the company is listed. They can also help you to generate trade sales. These are the benefits of bringing this venture capitalist into your businesses. Is it right? So today we'll stop here. We'll continue tomorrow. Thank you very much. We have seen the role of venture capitalist in the startup financing. They play a very important role. They play a very important role in the life of a startup. They provide initial capital. They take the risk. They believe in your idea. Even though others don't provide funds, these venture capitalists are there to provide funds to you, and therefore they play a very important role. Now we'll come to the funding part. How the funding is provided to startup firms by this venture capitalist. They call it by different names. Some name may sound funny, but it is like this only. First is called seed money. What is seed money? Seed money is provided at the very beginning, when a new idea is pitched up. There is no business right now, only an idea. Then the venture capitalist will provide the seed money, that is to begin with. The seed means the beginning of life. The life of a plant begins with a seed. The life of a business begins with a small level of financing which is provided to prove a new idea. That is called seed money. The second stage is called startup stage. It is here we are just providing an money for an idea. Like when you go to your parents and say, I have got an idea, your parents will give you some money. Even though it may or may not be successful, venture capitalists are also risk taker. So they may sometimes just like an idea and they will put money, but the amount of financing is low. Then the next stage is called startup. This is early stage firms. They have started implementing the idea, but they are at a very early stage and that need funding for expenses associated with marketing and product development. In the beginning, you will require funds for two basic reasons. One is product development, because in order to sell something, you need to make some products, you need to develop some product. If it is a tangible item, tangible good, then that product has to be developed, tested, checked again and again before you can start selling the market. And in the beginning, the marketing expenses are also very high, because you have to launch a new product. The market is already full of so many products. If it is a new idea, you have to sell your idea to the consumers. that if you buy this, it might help you. Then the next stage is called first round. First round is the funds provided for early sales and manufacturing. Funds provided for the early sales. Now the business has started taking shape, so you will require funds. Then it is called second round. Business has now again grown to certain stage, but still it is not yet profitable. Still the profit is not there. You require money for working capital, because your sales may be increasing, but to support the sale you need more funds, but you are yet to turn profit. Then the next stage is called third round, also called mezzanine financing. This is the expansion money for a newly profitable company. Now if the company becomes profitable, they will require more funds for scaling up, for expansion. Here comes the third round of funding. And then the fourth round of funding, this is called bridge financing. It is intended to finance the going public process. That means now the startup has become quite big, and it is the time to take the startup public, means make an IPO. So for making the IPO ready for IPOs, some more fund will be required before it becomes public, because once it becomes public, it can raise funds from public. Is it right now? So these are the different stages of funding for a VC, and you have to remember these stages in this order. First is seed money, then startup, and thereafter first round, second round, third round, fourth round, and sometimes I read in the newspaper there are fifth round, sixth round also. So depends on the business model, depends on how much scaling up you require, how much funding you will require. So the funds are provided in multiple rounds by this venture capitalist. Next is risk is different in different stages. Risk is different in different stages. Now we have prepared one risk matrix. Under that the same stages will come, but we will also discuss the risk at different stages. First, financial stage, period for which funds are locked in, risk perception and activity to be financed. This is like a summary of the previous paragraph. Seed money, the money which you provide at the very beginning to test an idea, the lock-in period for such funds are 7 to 10 years. So when you are putting seed money, you should know that this money will get locked for 7 to 10 years. And what about the risk at this stage? At this stage the risk is very high, extremely high. 90% or above money provided during seed money round, they are generally lost. And what is the purpose for providing seed money? The purpose is to test an idea, concept or idea or R&D for the product development, and the amount of financing is low. Second is startup. Here the period of funds locked is again very high, because you are funding a startup company. It will take some years before you can start making revenue, profit, positive cash flow. The risk perception is again very high. And why do you need funds here? You need funds to initialize prototype operation, develop products and marketing. So again you are making yourself ready to take your product or service to the market, and plus marketing efforts will be required to make your product known to the customers. Once the business reaches a certain level where they can start selling the product, now the first stage or first round of funding comes, where the lock-in can be 3 to 7 years. Still the risk is very high, and the funds are provided for commercial production and marketing. Second round, it comes a little late, lock-in period is about 3 to 5 years, risk perception is still high. At second stage also the business has not started generating profit. So therefore the risk is still high, but the market is increasing. Funds are required for scaling up purpose, for marketing, okay, for working capital. Then comes the third round where the lock-in period can be lower, let's say 1 to 3 years, and the risk perception is medium, because now the company have reached a certain level. Now the company has reached a certain stage, okay, because 5-6 years must have got over. Company have achieved certain scale, certain stability, but still the funds are required for market expansion, acquisition, product development for a profit making company. The third round of funding is mezzanine financing, and now the fourth round is for 1 to 3 years. Now the business has achieved a substantial scale up level, it has achieved certain stability, it has started making profit. So now the time has come to take the company to public, make an IPO. But before going for IPO, some funds will be required. So that is why it is also called bridge financing. Finance required to bridge the gap between today and the funds raised from IPO. So during that period, you need funds, and that we will call bridge financing. Tomorrow you are going to join, suppose, some venture capitalist firm, possible, not an impossible idea. And then in front of you, you will have lot of startup companies and asking for money, possible. Number of startups have grown up in lakhs now in India. Young people, college dropout people, college passed people, they come out with certain ideas and they want to test whether that idea can be commercially exploited or not. So these VCs receive lot of applications from startups every day. Hundreds of applications they are getting from startup. The problem is how to identify which startup we need to do the funding. So they have a certain stages involved, processes involved, and through which they will filter which startup company needs to be financed by them, because again there are hundreds of people who need the support or funding from VC. So I will divide this into 6 steps. The VC investment process is divided into 6 steps. First step is deal origination. That means you have to enter into a deal, and for that there are 2 ways you can do. You can directly deal with the startup companies, or you can deal through intermediaries. Between you and the startup there will be intermediaries. So who are these intermediaries? These mostly practicing chartered accountants. Wow, you people work as intermediaries. So they will help the VCs, this CA, MBAs, consulting firms. Okay, there are a lot of firms who specialize in such identification of startup companies, and they will help VC in getting the deal. So before sourcing the deal, what VC will do? VC would inform the intermediary or its employees about the following, right? Everybody has a different style of working, different risk perception, different way of looking at businesses. So you are asking intermediary to identify startup, or you are asking your own employees to identify startup. So you will give them some basic guideline. What is the guideline? You can give them guideline like sector focus, so that they do not bring unnecessary candidate in front of you. Is it right? Suppose for example, let us say there is a student called Divya, okay, and her father is looking for a perfect match for Divya. So they take the help of sometimes other people to identify a suitable groom. So they are going to give them some basic requirement. The candidate should be a CA. Candidate should be having a height of so and so. Salary package must be so and so. Working only in so and so cities. Okay, and so many other details which I will not write, but you have understood. So that the person who is trying to find a suitable match will not bring unnecessary candidate, okay, which will be rejected. So he will keep these parameters in mind. Same thing, same process VCs will follow. They have sometimes sector focus, like they will say we want to invest only in IT company, pharma companies, or education sector, like this. Then they would also tell them what is the stage of business focus, whether it is seed, whether it is startup, whether it is first round, second round, third round, fourth round. Explain your preferences, because somebody may invest in seed stage only. They want to take very high risk. But somebody wants to invest in a stage where the company have reached certain maturity. Then they would also specify who should be the promoters, what should be their experience, qualification, background. Then you should find out startup with a certain turnover. That also criteria they can give, that only identify startups which have 50 crore or above turnover. This list is not exhaustive, okay, this list is not exhaustive. Finding a new startup company is finding a good groom for a daughter. You have to ensure all boxes are properly ticked. Here the company would have a detailed business plan which consists of business model, financial plan, exit plan. So you have to identify companies with all proper detailed business plan. You have to identify companies which have proper financial planning and exit plan also. Exit plan means how VCs would sell their stake at a later stage. All these aspects are covered in a document called investment memorandum. The documents which covers all the requirements is called IM, investment memorandum. A tentative valuation is also carried out in the investment memorandum. So now the chartered accountants, the consultants, your employees will bring the startup companies, will identify certain startup companies and bring before you, right? Once the deal is sourced, the same will be sent for screening by the VC. That is, once you identify startup companies which are worth investing, then it comes to VC for screening. And what do you mean by screening? Screening means the senior people at VC level will evaluate those proposals and will see whether we need to go further and discuss, otherwise it can be rejected at that stage. So once the screening happens, it would select companies for further processing. Some companies may be rejected at the screening stage only. Is it right? Now next is due diligence. What is due diligence? You have identified a potential groom. What will your parents do? Then the parents will go and start inquiring about that person as to whatever they are saying. Is it true or not? Has he really passed CA exam? Ask for certificate, ask for Aadhaar card, ask for income statement to check the salary, ask for bank statement, ask his friends, neighbors, other people in the market, in the society about him. That is due diligence you are doing. Don't you think a VC will also do the due diligence when it is putting so much money in a company? So due diligence is carried out so that you will be able to understand that whatever information is provided by the potential startup company, are these true or not? Whatever revenue, sales, profit, cash flow, and so many other aspects of business, whatever they are saying, are these correct or not? So it's a detailed audit process. It is like audit but more detailed one, because you are putting your money here, and if something goes wrong, your money would be lost. So therefore we have to take into account the truth of all the information provided by the startup companies. This is mainly the process by VC tries to verify the veracity of the documents taken. So whatever information is given by the startup companies, they will be checked by the financial, accounting, legal team of the venture capitalist. Okay. So usually this venture capital has a team of experts, like they have lawyers who will check all the legal aspect. They have financial consultants, okay, who are going to look after the financial aspects of the business. And for doing the due diligence, if the size of the company is big, there is a heavy cost involved, that is fees you have to pay to these consultants and the legal team. Who will pay for this due diligence cost? Sometimes it is fully paid by VC, sometimes it is shared between the VC and the investee company, depending upon the veracity of the document agreement. So that they will agree who is going to pay for the due diligence cost. So first step was deal origination, identifying suitable startups, then it goes for screening, then it goes for due diligence. Now in the due diligence, suppose we are happy, okay, we want to take the proposal further, then now the deal will be structured. Okay, now the deal will be structured. Now the groom is finalized. So after the groom is finalized, what do? You will now structure the deal. Okay, the deal in case of marriage can be different, deal in case of startup financing can be different, but yes, the process is same. If you keep the process in mind, you will understand there are two different things, but the process is similar. The deal is structured in such a way that both parties should win. Any negotiation should be done in such a way that it gives rise to win-win situation. Keep in mind, if one party tries to extract everything and leaves nothing on the table for the other party, then the deal will not be successful. In many cases, convertible structure is brought in to ensure that the promoter retains the right to buy back the share. Sometimes, in many cases, it may happen that there may be instruments. Under such instrument, the promoter of the business will buy back the share from the venture capitalist. So they will issue such instrument which allows the promoter to acquire the stake of the venture capitalist. Besides, in many structures, to facilitate the exit, VC may put a condition. VC may also put a condition that the promoter must sell a part of his or her stake along with the VC. That means usually when they go public, they sell some portion of their stake. Even the promoters dilute some portion of the stake, and such clause where promoter is also allowed or required to sell a part of his stake is called tag along clause, where promoter must also sell a part of his stake along with VC. So tagging along, like you tag in your social media, the promoter is tagged along with the VC, right? So this is my deal has been structured, shake hand has happened, money has been transferred. What happens after the deal has been structured? Post investment activity will happen, which means what will the VC do now? Usually this VC will appoint a nominee in the board of the company. That means if there are 10 members in the board, VC will also appoint 1 or 2 board members. Why these board members are appointed? To protect the interest of the VC and to ensure that companies don't do anything which might harm the interest of the VC. Company must adhere to certain guidelines. This is written in their agreement that company must follow some guideline given by VC. Like for example, the company will have to prepare MIS. Do you know MIS? Hello, do you know MIS? Management Information System, which gives information about various aspects of business, okay, in a summarized form, so that VC will understand what is happening in the company. Then they should have a strong budgeting system. That is, every month they should prepare budget for the next month. This will give them an idea where they are going, what resources are required, whether there will be a shortfall in cash, etc. Then there must be strong corporate governance. Means decisions should be taken in the interest of all the stakeholders, not just few people. All basic professional ethical conduct should be there. Corporate governance is very important for the long run success of a business. Okay, long back when I was a student, we had presented one in the institute student conference, one seminar I had presented a speech on corporate governance and role of auditor. I am just giving you some additional information about me. I was an active student. So institute had organized a seminar called Corporate Governance and Role of Auditors, where as a student I had presented this paper and spoken also. Next is other covenants of the VC. Other covenants means other terms and conditions. And periodically keep the VC updated about certain milestone. VC will be after your life, keep in mind. If you raise money from VC, venture capitalist, they have put their money, so they would extract every pound of your flesh whenever they can. Every month they will ask you information. Have you achieved revenue target? Have you achieved profit target? What is your cash flow? And if the milestones are not met, oh my God, give explanation to VC. If milestones are not made, they will ask you 10 more questions. Why you did not achieve? Okay, why do you go to home at 7 o'clock? Why don't you work till 11 o'clock in the night? Why do you keep 5 days a week? Keep 7 days a week. Get up early in the morning. Call all your customers. Life is little difficult in the initial stages when you have taken funds from VC. VC would ensure that professional management is set up in the company. So these are post investment activity. Okay, you can understand from this raising of finance from VC. You can raise money, but at the same time you have to dance also according to their tunes. Not in every cases. but yes, many times they will make you dance to their tunes. You have taken money, now dance. Exit plan. VCs are very smart. They are the smartest people. You will also join their rank soon. They want an clear exit plan. How will they sell their stake at a future date? Okay. So company has to spell out in detail the exit plan. Exit plan can happen in two ways. One way is that VC will sell his stake to a third party or third parties. Okay. In that case, the company has to bring an IPO. Only then the VCs would be able to sell their stake to public. In the IPO, some portion of the shares are sold by VC to public. That is called offer for sale. Company is not getting money. Who is getting money? The investor, the initial investors, VCs are getting money, or they may ask company that you find some other investor to whom I can sell the shares. So that is one way. Either you sell in IPO or private placement, and second is, if you can't go for IPO or private placement, then the promoter will have to buy back the share from the VC. Promoter will have to buy back the share from the VC at a predetermined rate, under which they say our return should be around 18 to 25%. That means if he has invested 1 lakh rupees, for example, and if he is exiting after, let's say, 10 years, then the promoter has to pay them 1 lakh into 1.18 to the power 10 if they agree on 18%, or 25% if they agree on 25%. So that is the amount the promoter will have to pay to buy back the stake of the VC. In case there is no IPO or private placement, promoter has to buy back. Or it can be promoter will have the first refusal, right of refusal. Promoter has the first right of refusal, means whenever VC would want to sell their stake, it must be first offered to the promoter. If the promoter does not want to buy, then it can be sold to a third party. So that was exit plan for venture capitalist. I hope you liked it. Our institute has this time covered this venture capital funds, venture capital entire process in detail. Due to our limited time in the classroom, we have given only emphasis on what is more appropriate for exam purpose. But yes, this is a very interesting area, and there are chartered accountant students who work in VCs also, and they get to do all these deals also. Maybe you can also try. But I will tell you, they usually hire one very exceptional, talented, bright candidates who have got a very good academic records, like at least in CA course he has passed all the exams in first attempt, and if he is a rank holder, it is an added advantage when you approach the VC for employment purpose. Let us study the history of venture capital funds in India. In India, the government has also understood that we need to provide some incentive to the venture capitalist, to the startup companies. Otherwise, how the new idea will come? How the new idea can be converted successfully into a business proposition, unless there are people who are willing to put money in such new ideas. So venture capital started in the decade of 1970. Then Government of India appointed a committee to tackle the issue of inadequate funding to entrepreneurs and startups. Any country will progress if the entrepreneurs are also taking active participation. New ideas, new companies are given, roles or opportunities to perform. Then after 10 years, it was very slow in India, it is still slow. All India venture capital funding was started by some financial institutions, but again at a very low stage. Some financial institutions in India, they started All India Venture Capital Funding, ICICI, IDBI, IFCI, and then what government did in 1988, it announced guideline in the CCI. What is CCI? Controller of Capital Issues. So basically, now there was guideline for VCs or venture capital fund in 1988. So 1970 and now we have reached 1988 when you have capital control issue. But then what happened? Whenever the government brings regulations, there are lot of restrictions. Many enterprises don't like so much interference, restriction, etc. And therefore, the expectation that many new businesses would come, technocrats will come, new technology will be developed, it did not happen. Okay? Because so much of regulation, restriction, prohibition will make investment risky and unattractive. Then World Bank organized VC awareness seminar, and then people got more information about VCs. During this period, some big VCs started like TD, ICICI, GVFL, Can Bank, Pathfinders. Along with other reforms, the government decided to liberalize the VC industry. You know, in 1991 liberalization started and they decided to abolish that CCI, Controller of Capital Issue, because it was very restrictive. 1995, foreign companies were allowed to invest in the country. Is it right? All of you must have studied in economics. This 1991 was an era where, or that early 1990s was era where liberalization, privatization, globalization started, and because of which even foreign companies started investing in India. Again, new set of regulations were introduced in 1996 so that the foreign players should not have some additional advantage. New regulations were introduced. Now, IT revolution is started in India. The great thing about all this is that towards the end of 20th century, one major revolution took place, not just in India, but across the globe, and that was IT revolution. IT means information technology, software boom. It was called software boom, and even the telecom industry boomed during this period. Telecom companies like say Reliance, Bharti, okay, all these have started around late 1990s, and they, during this period, the venture capitalists were also there. Lot of venture capital funding took place, especially for these IT companies. How our venture capital legal structure is created? Let us talk about legal structure. Usually in India you will find two formats, two structure. Either it is in the form of a trust under Indian Trust Act, or it is in the form of a company. So in India usually the legal structure would be two, trust or company, but outside India there is one more popular legal structure for VC, and that is limited liability partnership. And these are the structure, legal structure, company, LLP, trust. In India, company and trust are there LLPs more outside India. And who are the people who invest in these venture capital funds? If venture capital funds have to invest in startup, somebody has to put money in venture capital fund also. So usually the investors in such venture capital funds are financial institutions, banks, pension funds, corporates, and high net worth individuals. That is, those who have got huge net worth, they want to earn even more at a higher rate of return, and they are willing to take risk. They are called high net worth individual. And what kind of structure of funds exist? Three main types of fund structure exist. One structure is for domestic fund, and there are two structure for offshore funds, means outside India. Domestic funds, that is those which are in India, what do? They raise funds domestically. Domestic venture capital funds in India, they will identify investor like, as we discussed, pension fund, financial institution, bank, and they will create a pool of fund, and either they are structured as a domestic vehicle for pooling of funds, and a separate investment advisor is there who will carry out the duties of investment advisor. The domestic vehicle or the legal structure can be either a trust or a company. And then there is an investment advisory firm which will guide about the investment process. Two legal structure are there, trust or company. In other countries, even LLP is there. In India, the trust form is more prevailing because of its operational flexibility. So that is, domestic fund are in the form of trust or company, and there is an investment advisor. Offshore fund, here we have two structure. Under offshore fund we have two structure. One is called offshore fund, we have offshore structure, and second is called unified structure. Sir, what is offshore structure? So under offshore structure, you see an investment vehicle. Investment vehicle means a legal entity which can be limited liability company or limited liability partnership, is organized outside India. Many VCs are like this only. They are outside India, they are registered outside India, and they invest into Indian companies, Indian portfolio companies. Okay, so you have this venture capital fund. These are managed by an offshore manager. These are managed by an offshore manager, and there is an Indian advisor also. What this Indian advisor does, it gives advice about the startup companies. They will do all the due diligence, they will screen the potential candidate, and they will identify, or what is called shortlisting the deal, and they inform the official overseas manager, and this venture capital fund directly invest in the Indian companies' shares. So these are their portfolios, P1, P2, P3. This is called offshore structure. In offshore structure, the venture capital fund located in foreign country directly invest in Indian companies with the help of an overseas manager and an Indian advisor. Then there is a unified structure. Under unified structure, there is one more adjustment there. Can you see that? One more addition there. Not only the foreign company invest in India, even Indian investors are allowed to invest. So when domestic investors are also expected to participate. In addition to foreign fund, the domestic investors are also allowed to participate. Overseas investor pool their assets in offshore vehicle. So they will raise funds, and invest in a locally managed trust. So they will invest through a trust, not directly. And in this trust, even the domestic investor can put their money. Foreign funds invest through a trust in India, in which domestic investor can also contribute, and then they invest in the shares of Indian company. Again, they have an overseas manager. There is an Indian advisor. This Indian advisor is to find out suitable companies, due diligence, advisory, etc. So that is about the structure of venture capital funds in India. Now the next is Startup India Initiative. What is Startup India Initiative? Have you heard Startup India? Have you heard about Startup India? Yes. So this is an initiative by the government, and they are providing lot of financial, tax and other benefits to the startup companies in India. The purpose is to create a culture of startups. The purpose is to promote entrepreneurship. The purpose is to make our young entrepreneurs invest into business ideas, and that will really help solve lot of problems for the masses. With that objective, that Startup India was started. One potential question is, what is a startup? What is a startup? So you will say, startup is an entity. It should be incorporated or registered in India. It could be incorporated. So if it's a corporate entity, incorporated, or if it is a limited liability partnership, maybe you can use the word registered. I am not a legal person, but at least it should be incorporated or registered in India. Condition, there are total 6 conditions. First condition is up to 10 years from its date of incorporation or registration. Second condition is incorporated either as a private limited company or a registered partnership firm or a limited liability company. So not more than 10 years should be over from its incorporation or registration, and only 3 legal structures are recognized there. One is private limited company, partnership or LLP. So the legal structure should be these 3 only. Then the third condition is the turnover for any fiscal year. In the last 10 years, the turnover of any fiscal year since incorporation or registration should not be more than 100 crores. These numbers keep changing, so you keep an eye on the government website, because this 10 year was, I think, earlier 7 years. Now they have increased it to 10 year. Turnover in any of those 10 years should not be more than 100 crore, and the entity should not have been formed by splitting up or reconstruction of a business already in existence. Human beings are very smart creature. In order to bypass this 100 crore requirement, they might split the company into 2 or 3 parts, so that one part does not have more than 100 crore. Government says, sorry, if you are going to create a business by splitting or reconstructing an existing business, then it is not allowed. Okay. And the last condition, 5th condition is, this startup should work towards innovation, development or improvement of products or process or service, or if it is a scalable business model with a high potential of employment generation or wealth creation. Now this is very subjective. You will have to submit an application to the government agencies. They will see your objective, and based on that they will allow you to be called as a startup or not. So as a good student, you will have to first remember this definition of startup. Maybe there are a lot of people who are not aware about this startup initiative. Your client may not be aware, but if you inform them that there is a such scheme, it helps them to get funding. It helps them to save taxes also, because there are a lot of tax benefits to startup companies. Is it right? So today we'll stop here. We'll continue. Hello friends, welcome back to this Startup India initiative. We have seen the conditions required for startups up to 10 years from its date of incorporation or registration. That means it should not be more than 10-year-old company. Can be incorporated as a private limited company, partnership or LLP. Turnover in any of those previous years should not exceed 100 crore, should not be formed by splitting up or reconstruction of a business, and the main objective should be it should work towards innovation, development or improvement of product, process or service, or if it is scalable business model with a high potential of employment generation or wealth creation. Then we are going to discuss some history of Startup India initiative. When was it started and how it has progressed till now? Not very important, but let us just go through it quickly. The Startup India story got a major boost in the year 2016 when the government started Startup India and Startup India programs. So the whole story of Startup India initiative started from 2016, and then afterwards the awareness about startups have increased. For your general knowledge, more than 56,000, even much more than that, companies have registered themselves as startup. The idea of Startup India initiative is to create entrepreneurial mindset. People should not just think about a job seeker or employment. He should try to become an entrepreneur, and therefore government has got several incentives also. They have set up a SIDBI run electronic development board. SIDBI is a Small Industries Development Bank of India, and this is a initiative electronic development fund where the Indian government has become a limited liability partner, a limited partner in a fund for the first time. Then there are other easy finance option also, because entrepreneur would require finance. What are the schemes to avail finance? Mudra scheme, tax benefit, 100% tax holiday under section 80 IAC. So you might have studied in your income tax, 100% tax exemption is there. An exemption from angel taxation is there. That means those angel investors also get exemption. The idea is to promote or give incentive to Indian startup companies. So after 2016, then there is January 21. What happened? There is a department of the government which is called Department for Promotion of Industry and Internal Trade, DPIIT. It created a Startup India Seed Fund scheme which is called SIFS. For MCQ question, all this detail you will require. This DPIIT started the Seed India Fund incentive. Now what is the purpose of this? From the name you can understand, seed fund. They are going to provide capital to these startup companies, and it had a fund of 945 crore, huge amount, to provide financial assistance to the startup companies. For example, for proof of concept, prototype development, product trial, market entry, commercialization, etc. So these are the various stages of entering into a commercial market. and for all this purpose you will need funds. It will support an estimated 3,600 entrepreneurs, oh my god, through 300 incubators in the next 4 years. So the target is to help 3,600 entrepreneurs. There are 300 incubators where entrepreneurs are given special care, attention, and that program will run for at least 4 years to start with. A startup recognized by DPIIT, this department says it should not be incorporated more than 2 years ago. At the time of application, and it should have a business idea to develop a product or service which has a market fit. Market fit means there will be a market for that product or service. There will be demand for that product. It should be having a viable commercialization. Commercially it should be viable, and it should have a scope for scaling, scope for increasing the size. So such startup can apply. The startup will get seed fund. How much? 50 lakh rupees. 50 lakh rupees under this scheme. And the priority sectors are, that means this will be given priority at the time of providing funds, which will have more of social and environmental impacts, like social impact, waste management, water management, financial inclusion, education. Oh, education is also there. Should I also apply? What is your view? Will I get the funding? Yes or no? Think and tell me. I don't know, because it has to be an idea, a great idea. Then food processing, biotechnology, healthcare, energy, mobility, defense, space, railway, oil and gas, and textile. So these are the priority sectors. If you are going to develop some product, service for these industries which are commercially viable, which can be scaled up, then this Startup India Fund will provide you funds up to rupees 50 lakh. And apart from the support from the government, there are few other reasons why India became such a sustainable environment for startups. So this will be a next theory question for you. Why startup have increased in India like anything? In the last few years, the number of companies registered as startups in India has crossed, I think, more than 50-60,000. What are the reasons for that? One reason is that India is a pool of talent. Oh my God, our country has a big pool of talent. Millions of students are graduating. People are graduating in different stream, commerce, like you people. Every year 10 to 15,000 students become CA. Thousands of students become engineer or doctor or so many other professionals. They come out every year, and now many of these young people have this mindset that we will not just go and do a job 9 to 5. We want to start something on our own, and with that objective they have started entering into business ventures. In the past, much of this talent was attracted only to big companies. When earlier, ask your parents, ask your elders at home, uncles, elder brothers, there was a mindset to pass the exam and take a job in a good company, a stable job, and enjoy the rest of the life. Young generation is restless now. The talented people, they don't want to just do a job. They want to do something on their own. They want to bring a change. And that is why more and more startups are being registered, mostly by the young people who have come out from the colleges. Second reason why startup is mushrooming in India, growing up in India, cost effective workforce. You can start a business You can hire employees, you can hire people who are experts in the field of science, finance, engineering, and the cost is not very high compared to cost incurred in other countries. In our country, skilled, unskilled, semi-skilled labor force is available at a lower price, much lower price, and that also is a reason why we are interested in setting up of a business. If hiring people was very expensive affair, then maybe one would not like to start a business. Third is Jio, okay, Airtel. They have resulted in, the competition has resulted in use of internet like anything, and it is very affordable. India has probably the lowest internet tariff and the highest usage of internet. Everybody is now hooked on to internet, addicted to internet. Earlier we used to say food, clothing, shelter was 3 basic requirement. Now we have added one more, internet. Okay, internet has reached rural areas also. Even people at rural areas are making effective use of internet for doing business, communication, and other things that you can do with the help of internet. They can do search on internet, they can find out information, and India has become the second largest internet user because of the affordable tariffs. Companies as well as startup are leveraging this easy access to the internet. Yes, if we start a business, we can also use internet for our business at a very low cost. And we know that so many people are using internet. So most of the new generation business are internet based. That means they develop apps. Apps can be downloaded. On apps you can provide services, etc. But what is that? At the backbone there is an internet. Next reason is technology. Technology has made various processes of business very quick, simple and efficient. Like this software. Okay. Because of the exponential growth in technology in the last few years, and which is available also to the masses for use, for consumption, etc., the startups have started entering into this business world. Okay, like this way of communication or teaching was not there 20 years ago, 15 years ago, or 10 years ago, where the student in a remote place in Karnataka can learn from a teacher in Pune, okay, sitting at the comfort of the home. Some of them may not have taken an early bath also, okay, some of them may be having tea and biscuit also and enjoying the lecture. How is that possible? Because of technology, and which is very cost efficient now. At our end also the cost has gone down. At the students' end also the cost has gone down. Same thing is happening in online shopping, online medical, and so many things. So technology has really played a big role in the growth of startups in India. There are development in the field of hardware, software, data storage, recording has become very easy task. Indian startups have now started working in areas like artificial intelligence, where the software will learn itself and execute things on its own, or blockchain technologies. These are again advanced technologies for simplifying tasks, which is added to the growth of these businesses. And last but not the least, why startups are growing in India? That is my question. Startup need funds, and if the funds are available easily, then they can think of starting the business. So as we have seen, if you have a good business idea, good business model, you will be able to raise funds from several government departments which we have read earlier. You can get angel funding, you can get venture capital funding. Instead of borrowing from banks and family and friends, now you have other models to search for, like angel investor, venture capital, seed funding stage investors. Then you can also get FDI, etc. Foreign companies are also investing into Indian startup companies, and because of that the funding availability has increased. Otherwise, how these unicorns would have grown in India? They have continuously got funding from international private equity investor, international venture capital fund, international private funds. Because of that, this culture of startup has grown in India, and from what we see, it will continue to grow. So this is one part of this chapter. The second part of this chapter is succession planning in business. So from the internet I have taken this image, thanks to Google, that in many businesses in India, not just in India, across the world, there is an urgent need to do succession planning, because the leaders, the promoters are getting old now. Is it right? And it will not be possible for them to continue to run the business for a very long time. There will be a time come when he will have to hang his boots and transfer the baton to somebody else. But that cannot be a sudden decision. That cannot be left to future. That cannot be like we will see what happens after 10 years. We will see. That we will see is very wrong approach. So such businesses where the promoters, the leaders, the people at the top management, they are going to retire in the coming years, they will have to do succession planning, and they will have to find out the next layer of leadership who can carry forward the legacy of the business, who can carry forward the vision of the business, who can run the business as efficiently as the previous leadership had done. Like in India, you can see Mukesh Ambani. He is now, as per the Google, 65 years of age. He is the chairman of Reliance. Now 65 years means if he was in a public sector, or if he was a judge of Supreme Court also, he would have retired. But because he is into private sector, as per the maybe company's internal rules, he can still lead the company till the year 2029. But what after that? After that he will retire. He will become very old to probably manage the company, we don't know. So therefore he has to now transfer or start planning succession. Start planning succession. He has got 3 kids, okay, and now some of them are on the board also. Some of them are on the board, but whether they will be equally efficient like Mukesh Ambani, only time will tell. Then in Kotak Bank, Uday Kotak, age 64, market capitalization 3.5 lakh crore, and again you can see the age. He has resigned as MD and CEO, professional in charge for now, and says elevation of old son to depend on the board. Same thing for Anand Mahindra, 68 years of age, to whom he should transfer the business. Kiran Majumdar Shaw, 70 years of age and no children. Oh my God. Nusli Wadia, Britannia Group, 79 years of age, and he has younger son Jahangir. Yusuf Hamid Sipla Group, 87 years of age, and few more who are going to retire soon or within next 5 to 10 years. Dilip Sanghvi of Sun Pharma, 67. Harsh Mariwala, 72 years of age. Marico, Baba Kalyani, 74 years of age. He is right now head of Bharat Forge. Pratap Reddy, 91 years. Apollo Hospital, Anil Agarwal, not anything to do with me. Vedanta, Omkar Singh Kanwar, Apollo Tyres, 81 years of age. These people have to have a proper succession plan. Otherwise, the same growth, the same efficiency which we have seen in the past may not be sustained. So this was Dhirubhai Ambani. He transferred the business to his son Mukesh and Anil. Now Mukesh Ambani, he will have to find out successor who can take the Reliance to the same great heights. Okay, so he has got two sons, Akash Anant Ambani and one daughter, Isha Ambani. So succession planning is required in business. You got some basic hint what we are going to discuss. So our topic is succession planning in business. In political scenario also, even though you are a great political party, if you don't have a proper successor, proper leader, the same political party may not continue to rule the country for a longer time. So every political party should have, must have, and try to find a good successor. Otherwise, as the main leader goes out of the scene, then the party will have a difficulty in future. I hope you got the message. Now the next is, what is succession planning? So succession planning is the process of identifying the critical positions in the organization, main roles in the organization, because suddenly if an employee leaves or a senior position manager leaves, you will have a vacuum and it is difficult to fill that vacuum. Therefore, we start identifying which are the critical roles in the organization and developing plans for individual to assume those positions. A succession plan identifies future needs of the people with the skill. What are the skill set we will require in future? Very, very important in business. Not only my current skill I have to look for, I have to also see what skills would be required in future. Because technology is changing, consumer behavior is changing, leadership role has to evolve, and accordingly we have to find out which person will fit into this kind of leadership role. Succession planning is an important priority for family owned business. Is it right? Where the family rules the business, promoters are the family members, they need to identify succession plan, as most of them are managed by a non-family leader, even though the ownership lies with the family. And if the main leader goes away, even if it is a professionally run company, if the main leader goes away, how do I continue to run the business? That needs to be planned in advance. Why there is a need for succession planning? The need for succession planning is, as you can understand, we need to identify right people are available for the right job today in the years to come. Because if you don't have proper person in mind and suddenly there is a vacuum, then you will not be able to fill that vacuum and it may cause disturbance in the organization. Provides a liquidity event which enables the transfer of ownership in a going concern to the rising employees, to the retiring employees, you can say retiring. Maybe some typing mistake is there, I will check. So what happens in a succession planning? Some employees will retire, which will create some kind of vacuum, some kind of disturbance in the organization. Therefore, we need a succession plan in place so that we can fill those gaps when the employees retire. It is a good way for companies to ensure that business are prepared to promote and advance all employees. not just who are at the management or executive level. When you will join some company after you qualify, probably you will join as an associate, means the starting designation, but then they will have a plan for you, and if you continue to work in that company, then maybe you will become a partner or senior partner in that company. So that is, the company should have plan not only for the top management people, they should also have the plan for the other employees also. The other employees should also know that yes, they have a chance of getting promoted to those senior positions. Management should also know, the owner should also know that if this top management position gets vacant, how I can promote my employees from within the organization. Second reason succession planning required, or first reason, is that it will help you to reduce the risk. It will help you to reduce the risk. Suddenly if a leader quits, then it takes a lot of time to identify a equivalent good candidates. Therefore, if you have a succession planning, you will be able to identify a leader. Without a good leader, there will be a disruption in the organization, uncertainty, conflict in the organization, because employees may start fighting among themselves and look for promotion. They will start playing politics with each other, and it may even endanger future competitiveness. The business organization will suffer on competitiveness if they do not have a proper successor to a leader who has quit. Next is cause removal. Sometimes some top management people or the people at the leadership level, they may be suddenly leaving the organization. They have to leave the organization. The reason could be culpable of gross negligence. So they may get a court order that this person should be removed from immediate effect. They may have committed fraud, like in case of Satyam. R. Raju was found of fraud and immediately he was sacked. But then you need to have a succession plan, and it becomes very difficult to manage the business during those times, or the top leader, top management may be guilty of willful misconduct, material breach while discharging their duties, and by the court or tribunal they have been barred from taking participation in the business activities. Keep the succession planning ready. What if suddenly a top leader, top management personnel is barred from attending the office? How do I do it? Then we have to also keep in mind, we have a pool of talented employees. You just can't hire talented employees. You have to retain them also, motivate them also, and they should also be clear that if the top management, this person retires, I have an opportunity. I will also rise to that level. And with that, the top talented people in the organization can be retained, can be promoted, and they can be a good candidate for taking the place of the top management people who would leave or who will retire. Next reason why we need succession planning is conflict resolution mechanism. Organization should have a very clear policy about promotion. Otherwise, there will be dispute among the employees. The employees may start having politics or doing politics with each other. They may not cooperate with each other. They may not share proper information with each other. Therefore, there must be a clear succession planning as to who will be promoted when a leadership role becomes vacant. Okay. Then alignment. In family owned business, succession planning helps too. So you are running a family business. Somebody else will take the role of now leadership. that leader who will take the role now should follow the same values, same vision, same culture, same direction which the family had. Otherwise, there will be a conflict of opinion, there will be disagreement, and the person will not stay there for a long time. So, what should be the business succession strategy? Evaluate key leadership position. That is, how do you go for effective succession? What are your key leadership position? Difficult to find quick replacement for a key leadership role. So identify which roles are critical and identify the risk or impact assessment. Then such position would bring transformation to the entire business, like the role of MD, CEO, CFO, CTO, Chief Technology Officer, Chief Operating Officer. Okay, so these people are key people and they have the capacity to bring a significant change. This is Ratan Tata, Cyrus Mistry. When Ratan Tata retired, they identified Cyrus Mistry as his successor. But after a few years, there was a dispute between the Cyrus Mistry and Tata Group, and Cyrus Mistry was removed. So you have to really be careful about identifying a successor. Unfortunately, he died and some other person is now taking the leadership role. Such position would create strategic direction for the organization. So these are the key leadership position. You have to keep in mind what are my key leadership position. Second, what are the competencies required for fulfilling this key leadership position, like what qualification required, what kind of behavior you require, okay, what kind of technical competency would be required to fulfill this requirement. And then we have to see, should I promote somebody from inside the organization to fill the key leadership role, or should I hire from outside somebody to fulfill the key leadership role? So that is what we have to see. Which are the key positions? What are the qualification required, competency required? Is there somebody within the organization to fill that role? If not, can we hire that talent from outside? So look for internal options. Look for internal option. If required, you can provide training and skill to somebody within the organization. There are two choices. Either you can promote somebody from within the organization, or you can find somebody from outside the organization to fulfill that role. So that depends on person to person. Then there is somebody called bridge leader. Like for example, I will not write any name. Suppose there is a company R Limited and there is a son of the chairman, let us call it A Limited, but he is very young. He needs to understand lot of things about business, management, leadership, human skills, communication skill. So in the meantime, what they do, they bring a bridge leader. Somebody from the organization will be, or outside will be hired, so that he can develop this fellow to become leader for the future. So that way, bridge leaders will act as a bridge to make the next generation ready for taking the baton for the future leadership role, and in the meantime this bridge leader will give them necessary talent, skill, etc. Challenges for succession planning. Although on paper it looks easy, you will also find it easy, but it's not always the easy task. Especially in case of startup, succession planning is more difficult. He himself is a startup. A startup itself has just started his business and now he is thinking of a succession planning. Although nothing wrong with that, every businessman should do that. but finding a person with similar mindset as that of founder of a startup is very difficult. Founders are different creatures from different planet. The way they think, outsiders cannot think. The way founders think about their business, a person from corporate world who has been working in corporate for many years, he will not be able to think like that. There is a difference in the vision, there is a difference in the mindset, there is a difference in the level of aggression, you can say, in a founder as compared to a corporate leader. So that is one challenge. You will not be able to find somebody who thinks like you. You can hire employees to work for you, but you can't hire people who can think like you. Founders are a different breed of animals or human beings. Secondly, it is very premature for startups to implement business succession. Because if you start looking for succession, people will ask you, you yourself are a startup company and it is too early to think about succession planning. First, to take the business to a new height, a certain scale, then maybe you can think about succession planning. So it is too early for a startup to think about succession planning. And the third biggest problem is founders are the face of the startup. If I think about Facebook, name one person from Facebook. Name one person whom you know who works in Facebook. Anybody? So only one name comes to us. Mark Zuckerberg or something. Spelling I am not sure. When you think about Facebook, Mark Zuckerberg names will come. Is it right? Same thing for other businesses also, which were founded by the startups. Okay, so if I think about, say, one Shadi.com is there, the face of Anupam Mittal comes only. We don't know other people. There may be 10 more people on the top level, but we don't know. That is the problem with the founders. People know the startup because of the founder. Founder is not there, people will not have faith in that startup only. Okay, so one cannot imagine a startup without a founder who initiated the idea and executed it, because he knows how to take the business to the next level. And again, if suppose he is not there, it is difficult to visualize that business. Although many times you can find a very good successor here also, but outside world knows a company because of the startup founder. Now they have added one more concept in your book called concept of unicorn. What do you mean by unicorn? Unicorn means those startups which have reached a valuation of $1 billion US. Those startups which have been valued at $1 billion US. This term startup unicorn, this concept of unicorn was first used by Ellen Lee. Ellen Lee had used the term unicorn for the first time in 2013. And why they are called unicorn? Because they are of rare variety. A startup company which have just started business, and in next few years it achieves a valuation of $1 billion US. 1 billion. This is 1 billion. Is it right? 1 billion multiplied by exchange rate of suppose 85. That will give you answer in Indian rupee. That is the value of a unicorn. And because they have grown to that level so fast, they are very rare variety. It is believed that unicorn is a mythical animal. Unicorn is a mythical animal who can move very fast. So when is a startup referred to as unicorn? When is a startup referred to as unicorn? It should have following features to be known as unicorn. It is privately held startup. It should not be an IPO or a listed company. Valuation should reach 1 billion US dollar. And it is very rare that you will reach that number. Rarity of success is very low. And the other common features of a startup companies are they have new ideas, something different from the existing way the businesses are being done. They have a disruptive innovation, consumer focus, and they are more based on technology. However, if a company's valuation falls below $1 billion, it will lose the status of unicorn. Okay, a company may be unicorn at one point of time, but it may not be unicorn at other point of time. The first unicorn in India, for a general knowledge question, a company called InMobi in 2011, which is an ad tech startup, became the first unicorn in India, and this company had received a funding of $200 million US dollar. So then based on this take $200 million they had given, okay, the valuation was $1 billion dollar, and it is the first unicorn. Okay, how many years InMobi took to become a unicorn? Only 4 years, from 2007 to 2011. But in 2018, another company called Udaan, a B2B e-commerce marketplace, it became unicorn in only 2 years. Oh my God, just 2 years, and 100, or you can say $1 billion company in 2 years, from 0 to $1 billion in 2 years. And now India has become the third largest ecosystem for globally startups. Like after US and China, India is the third one, where the number of startups have grown like anything. As per the statistics, there are about 59,000 startups registered by DPIIT. Then we have a concept of Decacorn also. Next line. What is Decacorn? Decacorn means those startups which have reached a valuation of US dollar 10 billion. Oh my God, US dollar 10 billion. That is the valuation of a Decacorn. Some of the Indian companies have reached that milestone also. Like for example, Baiju, Paytm, Flipkart, Swiggy, Oyo, their valuation have crossed $10 billion. Sometimes it goes down also. So this statistics is based on a certain point of time. If you ask today, some of them may have not, some of their valuations have gone down also. And there should be no doubt that in the next few years, there will be more and more unicorns and more Decacorns of India. Now I have given you problems for cell practice, which are nothing but question asked by the institute in different exams, RTPs, MTPs and study material, and those questions are based on the theory that we have already covered. So today as a homework, you will read all these questions. You will get an idea what kind of questions are asked from this particular topic, because it is the same thing asked in question answer format. Will you be able to do it? Say yes, we can do it. We are the young India, and once we decide to do something, we will get it done. So thank you very much. See you in the next lecture.